Okay, we're going to go to Q&A here for the last 15 minutes. Sam, do you want to take off the slides here and just put us up on the screen and then scroll up on the comments so I can read those?
David had a question beginning about...
He said, appreciate your team. How's your team balancing new funds and opportunities versus maintaining sufficient focus on existing funds, such as the Aspen Income Fund?
I'll jump on that one. The Aspen Income Fund, we love that fund. That's our biggest fund. It's our oldest fund. It's $85 million. We got investor money there. That thing is a little rocket ship. We have an entire team dedicated to that fund. So it is focused on residential, and that's its focus. And honestly, it's not the black sheep by any chance. So, it is. You talk about the differences with the income fund and the private credit fund. So the private credit fund is going to be focused on commercial, and it is focused on commercial and especially multifamily.
Yeah. The great thing too is, one, there's a lot of overlap potential and cross training that we have internally, right? So a lot of our teams can work in different parts of our business, and a lot of our staff kind of work on multiple verticals. But to the extent that we like the income fund, we do servicing in-house, we do asset management in-house. And so we staff to those functions, and those are dedicated resources to those functions. Whereas our other models, don't require as much depth in the resources or staffing at that level, but we can have a broader perspective and impact on multiple of those.
Great question, David.
Yeah. Jim, do you want to add anything to that? So you pop on there.
Okay, Andy, the commercial bridge loan portion of the multifamily held under the Aspen Income Fund? No. So the income fund holds only residential, and so multifamily, like greater than 5+ units, is considered commercial. And so we're only doing multifamily in the new private credit fund. We do have a couple.
We have a couple.
There are a handful of loans in there that before we started the other. So
yeah. So when Jim was talking about the foreclosures and stuff, he was talking about our note funds where we're doing residential. So it has nothing to do with the commercial, kind of what's happening in the multifamily space.
Yeah, and just to follow that question, Andy wrote, he said, what exposure to the bridge loans where the loan to value exceeds 100% if a senior plans to handle potential foreclosure? So in those scenarios, our LTVs are extremely low. I think our average LTV on the commercial ones that we have in that portfolio,
which in the income portfolio,
income fund, are under 50%.
Yeah,
and in the credit fund, it's generally under 75%. And so
I don't think we have anything over 100.
There's
not even one.
Not even close.
Yeah. So great question.
Yeah, great question. But you have a lot of margin, right? Even with values, expansion of cap rates. I mean, that's the whole deal. Is go lower the capital stack, you reduce that risk from potential cap rate increases. So,
Cameron,
excited to participate in more oil and gas funds. Hey, we are too.
I'm getting my checkbook out.
Appreciate the salary distribution on the energy fund. Yes, quarterly distributions moving forward. So that's on a quarterly distribution frequency. And you're asking the minimum annualized return of 15%. So there is no minimum, right? The annualized returns and the distributions are driven by the underlying income being generated from these wells. So we anticipate that the baseline, will be at that 15% level. Based on the assets we have right now. We anticipate that may increase over time. So
the second asset we bought hasn't even, are we taking any income from that yet? I don't think it's even hitting yet.
No,
so it should be hitting here
soon. Everything's kind of
delayed. And then we've got another purchase ready. So it's going to be building.
Yeah. And we still got another 15 to 20 million to go shopping with in that fund, but we have a few kind of acquisitions teed up there. So once it gets fully deployed, right, we're not trying to reserve some cash back to go shopping and for new assets. That we expect those yields to continue to rise.
So, but he's asked, can we say, should he expect 15%, by the end of the year?
I think that's right now, as far as everything looks and how the portfolio is performing, we expect to kind of maintain the current distribution yield number. So, yep. So the K1s on the energy fund. So the K1s will likely not be delivered until July or August. And unfortunately, that's just the nature of the energy industry. The reporting is very delayed.
This is the energy industry, Phil. It's pain in the butt. Sorry about that, but the energy industry is very delayed reporting, and we don't have, it's just the way it comes from our servicers.
Yeah.
And there's
we don't
no
even,
way to accelerate it.
We don't even get the 1231 reports until April anyway.
So the only thing we could do is have our year end, in Q3 or something, change our year end, and then we could do it, which we might do, because I do hate missing these K1s too. I'm with you. So
yeah, but on that one, we did let people know very early that was, likely going to be delayed, and then we did give potential tax liability to reserve and to make a payment. So obviously during the weekend to make that deliver those as quick as we can, but that will kind of be generally the outcome for energy investments. And just as a broad comment, if you are investing in private alternatives, anything that's private, we just generally recommend you extend your tax return,
pretty much.
because the more you invest in these, the higher the chances are that one might be delayed, or in something like this where it's just kind of the expectation you want to do it. So we all delay our tax returns, and it's not a huge deal. But just encourage
it's the way it is.
Yep.
Are you more bullish for the new energy fund 7 versus upstream? Honestly, we're seeing probably the same level of availability of assets and the same level of pricing, which means it's probably going to be just as good.
Yeah. We've not really seen a change in the market at this point, which is why we're trying to buy as much as we can. Because
so at this point, I would see the same level of expected performance. And roughly, when do we expect it to open? Cameron is asking. That would be summer, we're thinking.
Summer, likely late summer. So similar to last year when we launched that in the summer. So once this fund is fully deployed, which we expect that to happen over the next quarter or so, we'll go right back into the market with the new fund and just kind of continue that acquisition pipeline that we've been building.
Todd is asking what bank we use. Yeah, we use Silicon Valley Bank. No, just kidding.
Shouldn't say that. No, we have lots of different banking relationships. So we're spread across probably 10, 12 different banks across our different assets. So our primary banking relationship, we can talk to you offline, Todd. It's a local credit union here we have a great relationship with, and great platform, great protections for all the borrowers of the bank.
Todd is asking about a bank failure epidemic in the future. Todd, I'm not. I actually am well aware of what happened in 2008. We made a lot of money in the bank failures in 2008 through our distressed debt. If you look at bank health right now, if you look at the distressed banks out there, there's hardly any. There's a couple smaller banks that are exposed to commercial real estate a little bit, and there's a concern, primarily office. It's a very small number. If you actually look at there's a list, the unofficial problem bank list, and you can see there's hardly anybody on there. It's just a very small list. So banks are generally very well capitalized in America right now. We're not at risk. So the housing crisis in 2008 became a banking crisis, and that's when you get systemic problems. Housing crisis don't always create a real systemic problem like for the system.
Yep.
But when a banking crisis do, and we're not seeing this becoming a banking crisis yet, so I'm highly confident. You look at the numbers, and you can go look at the aggregate numbers in the banking sector. It's all public information at the FDIC.gov,
yep. And
you can go see that the banks are actually quite healthy, except for just a teeny tiny number of them, and they're small. They're smaller banks, so yep. I'm not concerned at all. All right.
Phil asks the Upstream Energy Fund co-sponsor has historically averaged 2.5-year hold period. At this point, to anticipate earlier divestment than a 10-year pro forma. So, it's similar to in any of these assets. There's good times to buy and good times to sell, and those cycles kind of go back and forth. And the time periods between those can be a few years. It can be longer than a few years. And so, again, the reason that we created a 10-year hold period for that fund is we want to have the maximum flexibility for maximizing the opportunity in the market, right? If and when the market turns and it's a good time to sell, we'll be selling, right?
But as long as you're making 15% returns, who's in a hurry to sell? It's like,
Exactly.
and that's just cash.
Yeah. When you're making the kind of level returns you're making, if you're selling, right, it means there's probably not a lot of good acquisitions that you can replace the capital with.
Right.
So it's that dichotomy of, what's better is getting all your cash right now or continue to have distribution. So
Yeah,
we'll make all those
Great question,
valuations
Phil.
as we go along, and determinations depending on what the market's doing. But right now, when it's a buyer's market, we're focused on buying. At a certain point that will shift, as it always does, and then we will definitely be evaluating potential sale. So appreciate that question. Great questions, everybody. Francois, love you. Hope you come visit again soon.
Congratulations to the Aspen team. Come on, and to our Aspen investors. So
Absolutely.
who've been with us. We're just so grateful for you all going on this journey with us.
Yeah. Awesome. Well, everyone, thank you so much for joining live. We will put this on our website and send it out here soon to be watched at your convenience. So with that, thanks so much.